Okay, let's get right into it. But first, the mandatory disclaimer. This is for educational purposes only. It is not financial advice.
All right, picture this. The date is Monday, January 5th, 2026. Markets are about to open, and the world just got turned upside down over the weekend. What we are looking at is not just another geopolitical flare-up. No, this is a potential reordering of the entire global energy map. So let's break this down. While Wall Street was sleeping, two absolutely seismic events went down. First, in a lightning-fast military op, U.S. forces captured Venezuelan President Nicolás Maduro. Now, the stated goal here is a temporary intervention to overhaul the country's oil company, which has been in a state of collapse for years. At the same time, halfway across the globe, the Iranian regime showed its first real sign of cracking. The supreme leader actually acknowledged the legitimacy of mass protests led by the Bazari merchant class. Now, you have to understand, these aren't just any protesters. This is the economic engine of the country, the very group that helped bring the regime to power 4 decades ago. Their dissent? That is a huge signal that the sanctions might finally be hitting a breaking point. This is the twin collapse. So, with the opening bell just hours away, what's the obvious play? For every trader on the planet, the first instinct is to go with what they know, to follow the conventional wisdom. I mean, this is market muscle memory, right? You've got turmoil in Venezuela, an OPEC founder. You've got major instability in Iran, a huge power in the Persian Gulf. The playbook is simple. Supply is at risk, so you buy oil. You buy it now, and you expect prices to spike. That's what every headline is going to be screaming. But what if that muscle memory is dead wrong? What if the market is reading these signals completely backwards? This is the central question we have to ask today. With two pillars of the oil world shaking, why on earth would prices be heading for a crash? And that brings us to the core thesis. We are not looking at a standard supply disruption. We could be on the verge of what I'm calling an inverse shock, a scenario where the reality of supply completely and totally overwhelms the psychology of fear. Let's be crystal clear about what this means. An inverse shock is when the market sees war and instinctively prices in scarcity, but the actual event is about to unlock a massive new wave of production. So fear says prices go up, but the fundamentals, the actual numbers, say they're about to fall off a cliff. To get the scale of this, you have to know our starting point. Before this weekend, the world was already swimming in oil. We walked into this crisis with a global surplus of 1.5 to 2 million barrels every single day. The system was already oversupplied. And that surplus, honestly, it's a drop in the ocean compared to what's at stake in Venezuela. We are talking about 303 billion barrels of proven reserves. That is the largest single concentration of crude oil on planet Earth. It's been mismanaged, it's been locked away for years. This U.S. intervention isn't just about politics, it's about turning that spigot all the way back on. And the potential here is just staggering. Right now, Venezuela is barely pumping 1.1 million barrels a day. But the explicit goal of this U.S. op is to bring in the expertise, bring in the capital, and get output back to its peak. We're talking 3.5 million barrels per day. Just look at that difference. That's an additional 2.4 million barrels of oil hitting the market every day. More than enough to single-handedly swamp the global surplus we started with. So here's the bottom line. If this bear case plays out, if Venezuela's production comes roaring back online, and if Iran's crisis leads to a political change and sanctions get lifted, we are not looking at a small price correction. We are looking at a scenario that could push Brent crude down towards a $40 a barrel target by the end of the year. Now, this is not a one-way bet. Every thesis has to be stress-tested. And there is one massive, glaring risk to this whole analysis. It's the ultimate geopolitical wildcard, the Strait of Hormuz. This one single choke point creates two completely opposite futures. In the bull case, you have chaos. Iran feels cornered, it lashes out, and it closes the Strait of Hormuz, choking off a huge chunk of global supply. At the same time, the U.S. gets bogged down in a messy, expensive occupation in Venezuela. In that world, oil spikes to $150, maybe higher. But the bear case, the inverse shock we're talking about, is that Venezuela floods the market with cheap oil while Iran's regime implodes, eventually opening up their reserves to the world. In that case, oil crashes. Both of these are now plausible. So how do you watch this unfold? How do you translate this high-stakes chess match into actual market signals come Monday morning? All right, here's your watch list. First, the energy sector ETF, XLE. Expect a massive knee-jerk rally at the open on war fears, but watch it closely. If that narrative starts to shift towards supply, the long-term risk here is sharply to the downside. Second, defense and aerospace stocks. Look at ITA. Direct U.S. military action is almost always a catalyst for this sector. Third, emerging markets, the EM. Specifically, keep an eye on contagion risk spreading to Colombia and Brazil from a destabilized Venezuela. And finally, gold, ticker GLD. Look, when a global superpower says it's now running another country, that creates a level of uncertainty that is practically tailor-made for safe haven assets.
So as you watch those screens light up, this is the fundamental question to keep in your mind. The market is about to price in fear, chaos, and the history of Middle East wars. But is the real underlying story here one of an unprecedented market-crashing flood of supply? That is the trade of 2026.
And we'll end where we started, one last time. This content is for educational purposes only and is not financial advice. Watch the signals.